Hi everyone, welcome to our webinar, our quarterly webinar, what's shaping the diamond market in 2023. And I appreciate you joining us. I appreciate your time. I hope that I can give you something to take away with you, and some food for thought about where we're at in the market at the moment. I really enjoy these quarterly gatherings that we do, and it's been going on for good, I think 4 years now that we've been holding these quarterly trends webinars, and it's great to it helps me understand the market better. That's for sure. So I appreciate your time. And I appreciate the conversation that this platform enables us to have. Our goal today is to, of course, understand what's happening in the diamond market, but we're going to go through a few sort of steps on that journey. The first would be to understand or to at least present the current price dynamic as best we can. We'll give a review of last year, 2022 as a whole, and that should hopefully give us some perspective going into 2023. And of course, also in the context of the holiday season, how was the holiday season? We'll try and put that into some sort of a perspective for you, as the beginning of last year was very different to the end of last year, or the other way around. Maybe the end of last year was very different to the beginning. A lot happened in the course of those 12 months. And then finally, as we try to understand how the market will evolve and develop in this year, it's important, I think, to take a look at the main market makers. What are the big stories that I'm looking at from an editorial point of view, and also in terms of the sort of supply demand price dynamic, what's going to influence the industry this year. And so that's our little plan for the next hour. I will leave some time for some questions. If you have any questions, please put them in the Q&A. And then if you want to chat amongst yourselves, feel free to do so in the chat icon on the Zoom application. Before we get started, I do want to give a quick shout out to Shimon Gerstensang, who's the head of pricing at Rapaport, and a source of great wealth of information and insight about the market for me anyway. And so a lot of the ideas, as always, on these Diamond Trends webinars are a result of some of the conversations that I have with Shimon, and it's greatly appreciated. So at the last webinar that we held, which was around November time, I presented this slide to put the year into context, because 2022 was always going to be compared to 2021, and 2021 was a great year for the industry. We had strong jewelry sales, which fed into the polished market and lifted prices and profit margins within the midstream, and then boosted the rough market as well, and manufacturing. And so you had this sort of trickle down effect. It was really a great example of how an increase in demand can really pull up the rest of the industry. And as we've discussed in the past, and it's well documented now, that recovery was really boosted or was really stimulated by by a recovery from COVID. That the market dropped very dramatically during COVID, and then there was this sort of gradual return to the new normal, or to doing business within that sort of COVID environment. But then as we gained confidence, as consumers gained confidence to shop and really honed in on certain types of gifting, the jewelry market really was able to capitalize on that, and we had a great strong recovery, a record year for the industry in 21. And the contrast was last year that I presented on this slide, that there were weak jewelry sales, and that fed caution into the polished market. We saw a reduction in prices and margin squeeze, and a slowdown in rough buying. But I bring this slide up again because I think it wasn't entirely accurate. I think maybe it was a little harsh to say that 2022 as a whole was a weak year for jewelry sales. It's not entirely true. As we will go into later in the webinar, we tend to forget that the beginning of the year had strong momentum. We had that momentum from 2021 that fed into that first quarter, and even the first half in terms of jewelry sales weren't quite yet affected by the various factors that brought caution into the market, and there were the obvious sort of factors. That was the geopolitical story that broke out in February in Russia and Ukraine. And then there was the high inflation and economic uncertainty, particularly in the United States, and the slowdown in China due to the ongoing sort of lockdowns, COVID-related lockdowns in China also. So the combination of those really fed into the caution that came about more in the second half of the year. But when we look at the year as a whole, it wasn't that bad. And so I bring this up again because I don't want to give the impression that it was a disaster year. It wasn't at all. I think we can be quite happy with how 2022 went. It was always going to be a difficult year given the strength of 2021, given those comparisons that we had to make. Anyway, that's just maybe a little disclaimer or a bit of a teaser of what's to come in this and what we'll discuss later in the webinar. But looking at pricing, we see that flow of events in diamond pricing, I think, as well. You know, particularly as we look at at the beginning of 2022, that we had this increase and that momentum that we were riding from the previous year, and prices continued to increase nicely in that first quarter, and then as I would say, the Fed started to increase interest rates to combat the high inflation, and there was that economic uncertainty. And I would put that first before the geopolitical stuff. Obviously, the war in Ukraine had an effect on global sentiment, but the US economy was working on a different dynamic, and I think that and again, bringing in the China story as well, brought a slowdown and more caution in our pricing, and we saw this decline, this steady decline for the rest of the year. And I point particularly to that black line, which represents the 1 caraters, and that trend has continued into 2023. As we look at this dividing line, is the beginning of the year, and it's stabilized a bit, but the overall trend is still sort of on the down. An interesting graph would be the 30-pointers as well. That's the blue line, where we have seen somewhat of a recovery and an upturn in pricing of those 30-pointers as per the RAPI index. I always like to look at it on a quarterly basis and what's happening. And so again, we see, and this is the 1 caraters, we see that in the first quarter we had that strong increase of 13-14%. And then there were declines of 5%, 9.7% in the second quarter, 9.7% in the third quarter, 8.8% in the fourth, and so far this year, as of yesterday, the RAPI for 1 carat is down by 1.2% for this year so far. So so that's again just another way of looking at the previous graph. To put it in the context of a longer term context, we see these sort of recoveries from various crises that we've had at the beginning of this initial dip was from the financial crisis, and then had the strong recovery through 2009 to 2011, and then this steady decline through the next decade, really, until we got to that recovery from COVID. And it's the declines that we've seen in the last year have brought us back to below those 2008, 2009 levels. And that's just something to think about in the greater context of things, particularly on these 1 carats, which we sort of look at as a flagship category when we're looking at the RAPI index. And so when we're looking at prices and what influences prices, there is demand. As we mentioned, those 3 sort of factors, I think, all played into it: the US economic uncertainty, the geopolitical influence, and the lockdowns in China all played into a slowdown in demand. But the other side of the equation that affects prices would be on the supply side. And I think it's just worth noting that that there are a lot of goods still on the market that we're seeing on RapNet. That this graph it shows the last 5 years from the beginning of 2018, when 2018 and 19 was a period where we were talking a lot about this excess inventory that was on the market. If you recall, there were 2 or 3 new mines. The Gachagua mine in Canada in particular came on stream, and that sort of gave inventory a bump and affected this activity in the midstream, that the midstream felt was holding a lot of goods and sort of playing with its pricing accordingly. But this drop was the boycott of RapNet over the COVID period, but we had a very quick and strong recovery from that. But what surprised me, at least, is that the volume of goods that came onto RapNet and kind of as a representation of the greater market, that these levels have exceeded pre-COVID levels. Those 2018 and 19 levels we were still higher than that. And that's something that's interesting. It seems to be coming down a little bit, but again, in the context of the last 5 years, the inventory levels on RapNet and in the market, I would say, are still fairly high. And so the combination of that high inventory, and I would stress the demand side more as having a bigger impact on pricing, but the combinations of lower demand and high inventory that's still in the market sort of gives us some understanding of why prices have come down in 2022. Just to look at the inventory that's on the separate categories that we showed you. And I'm sorry I couldn't bring. I had some issues with my playing with the data and with Excel, but I wanted to show the price trend with the inventory trend. I wasn't able to do that for some reason. But this is the inventory of the Rappi category for 30 pointers. That's D2H, IF to VS, clarity goods, and we see that. And I would keep this in mind. This blue line in mind that's what we're looking. That's what we're comparing it to. That we had this increase at the beginning, increase in prices at the beginning of last year, the first quarter, and then the steady decline. And then we've seen from around November, stabilization and a steady increase in pricing. And the inventory graph shows a similar trend in the inverse, as it should. As inventory rose, as supply of these goods increased in the first quarter, that's when we saw. Sorry, this is actually we're looking at this graph should show. This is the beginning of 2021. As we saw the increase in prices at the beginning of 22, there was this decline, this sharp sort of decline over here of inventory on RapNet and in the market. And then there was a slight bump, and an increase which influenced that decline. And since sort of midway through last year, we've seen the steady decline in supply of 30 pointers, and that's when we start to then see that the lower supply is supporting prices on the 30 pointers. So it's kind of nice to see from a data analytical point of view how it kind of works out and supports the argument. But it's real numbers, and it also supports what we are hearing and seeing in the market. The opposite, we haven't seen the same trend in other sizes. We see here in the half caraters that inventory did come down in a similar way to the 30 pointers at the beginning of last year. And that's the way it should be, by the way, that the first quarter generally is a period of strong selling and strong trading as retail replenishes goods after the holiday season, and so the midstream is selling more to their retail customers. And so we saw that traditional decline in inventory here at the beginning of last year, and then it picked up as manufacturing came on stream again to feed into that retail demand. But the level of goods on the 50 pointers has sort of stabilized, and we didn't see that drop that we saw on the 30 pointers. And so the 30 pointers need a bit more analysis of what caused that drop in inventory. Where was the demand coming from, or was it simply just a lack of manufacturing? And that could be. And there's another factor that we'll get into in the next in 2 slides time. So hold tight. But we see in the 1 caraters, it's also kind of an inverse of what the pricing is showing, that we saw that decline, that the decline in inventory in the first quarter that supported prices, and then inventory steadily rose in the 1 caraters through the rest of the year, and so you would see, if you recall, the Rappi index for these goods came down through that period while inventory has come up, and then we have seen a bit of a decline over the holiday season of inventory. And that's and certainly in the last month and a half, and I think we are starting to see some stabilization in the 1 caraters as we see in this black line over here. There seems to be some support if you are looking at it from a technical point of view. But it makes sense when we look at that inventory. That inventory has come down a little bit in the 1 caraters. But overall, when we're looking at at inventory as a whole, there is still that large volume of goods, and as usual, it would be predominantly of goods that are less in demand, lower quality goods maybe that typically don't move as quickly as other categories, and particularly when there's uncertainty in the market, buyers tend to be more picky and selective of the goods that they're buying. So what does influence inventory levels? And as we mentioned, people are buying less, and so manufacturers and dealers, the midstream, are left with more goods in their inventory, and so they're the bearers of risk when it comes to inventory generally, is the midstream. But we did see those lower orders coming from the US in the second half of the year, and in China as through those periodic lockdowns that have since come to an end. When we look at those 30 pointers, that third reason that I mentioned would also have to do with whether to certify those goods or not, and particularly in the 30 pointers, it would be it's interesting to think about as prices came down, as prices came down for the 30 pointers, the cost of grading those goods take up a higher portion of the cost of the overall cost of production, of manufacturing those goods. And so perhaps as prices came down, manufacturers and suppliers felt it wasn't necessary to, or it was more cost effective not to grade those goods and bear that cost. And so they stopped. And so one of the contributing factors to the drop in inventory that we're seeing on RapNet, which only displays certified goods, would possibly be that there were less goods being sent for grading, and so being able to put those goods on RapNet. As prices have started to come up again, and so the cost of grading would take up a lower proportion of the overall cost, and maybe it's and also as China starts to come back into the market, we know that China bears greater influence on the 30 pointers than other categories on a global scale. That there would be greater demand for certified 30 pointers, and it would be more and it would be less cost prohibitive to grade those goods, as well as prices have started to come up, as we saw in the previous slides. Overall, we are seeing lower production levels. And that has been the case since through the second half of last year, I would argue, and certainly carries on through to today. That Indian manufacturers have lowered their output, and that could be and that's for a number of reasons. Because they are holding high volume of goods in inventory. Also, that there's less rough that's coming to the market. The El Rosa goods have been more prohibitive, I guess that is maybe a way to put it. Although as we'll go into, the Russian goods are still coming to the market, but I would say with less volume than before, for sure. And so we see the production levels in the India data. India is our best indicator of manufacturing levels, as I think the number is around 90% of all diamonds go through India for manufacturing, and so it's a good barometer to see if we look at rough imports into India, what volume of rough is India buying, and the polished exports that it's exporting out of India, how much polished are they selling, gives us some indication of manufacturing activity that's going on there. And so we see that through, and this is on a quarterly basis, that this graph, that India's rough imports did decline compared to 2021, particularly in that second quarter, which was maybe the depth of the or at least when the Russia crisis began. And there was a lot of uncertainty about the Al Rosa goods and whether it would come to market, how they might be able to buy, or how Al Rosa would sell, etc. We did see a bit of a spike in the third quarter, and then the fourth quarter was down again. But but I think maybe the better indicator would be 2021. We see that there was for 5 quarters in a row, post-COVID, that there was really a strong rough buying and imports into India, and so that sort of and the bar lines are the volume in terms of carats, and the blue line is the value of those goods. And what's interesting is that the volume has come down, but the value of the rough that came into India has actually increased in 2022 compared to 21. And that's, again, we see that spike in the first quarter, because in that first quarter, stimulated by the strength in the market, the momentum from 2021, we remember that rough prices came up quite strongly. And in fact, and they, at least on the site goods, they maintained that sort of level throughout the year. And De Beers reported, I think it was about 20% increase in its rough price index that in 2022. And so those higher volumes higher pricing brought higher values. And it's not only the price increase, but there was also, I think, a shift to higher value goods during the last year, that we heard a lot about the largest sizes or being in more in greater demand on the rough side than the smaller sizes. But the point I want to make about inventory is that the Indian manufacturing community went into 2022 with a large volume of rough in their safes, let's say, and in their inventory, and so that again fed into that high volume of polished inventory that was maintained through last year as they worked through that rough and brought in a bit more through the year. In terms of India's polished exports, it's kind of a similar pattern. But I would say that in 2022 we see this drop off in demand, and particularly in the fourth quarter, which I found quite surprising, actually, considering that is somewhat of a peak season. I think, although I think most of the holiday orders come in typically in the third quarter. We often see that the retailers have a peak in their inventory in the third quarter. But clearly there was a drop off in demand through 2022, and also in value as prices came down. That we see this drop in value as well. And so when we look at coming back to the year as a whole, and how do we sum up 2022 in terms of the value of the pipeline of the diamond distribution chain, and maybe think back to that first slide that I brought up about, you know, that comparing the sentiment in 2021 versus 2022. And my point that it wasn't such a bad year overall when we look at the year as a whole. I think this table kind of reinforces that. And these are really sort of back of the envelope calculations that I've done. I wouldn't take it as sort of as the Bible, but I think the trend is there, and there is a basis for these numbers. Rough production continued. You know, we didn't get the data from El Rosa, which accounts for, you know, 28%, 30% of global production, but we know that they had planned about 33 to 34 million carats for last year, and we understand that they would have continued production regardless of this, irrespective of the sanctions that came through. So in terms of rough production, and considering the increase in pricing of rough diamonds that we did see, that the value of rough production did come up last year. There was a bit of that wasn't mirrored in the rough sales. Considering the El Rosa goods that didn't come to the market in the same volumes, although I think they did come to the market, they didn't come to market in the same values. So we're looking at rough sales of sort of meeting or just slightly above the previous year, and you know, except you know, taking El Rosa out of the equation, the mining companies had a strong year. De Beers had a great year last year. As we're still waiting for their final results, but they had a very strong increase in rough sales, at least in the sort of strong double digits increases. In terms of polished production or polished sales, at least, I would say, and this is based on those India numbers really, that we're looking at about a low single digit decline from 2021, and similarly in diamond jewelry sales. Again, when we look at the data that's available from the first half of last year, it was there was good momentum in retail in the United States, and particularly in the luxury brands. The high-end luxury brands had strong first halves of the year, and so taking the year as a whole, I think we're probably looking at 5 to 10% decline in jewelry in global jewelry sales. I took the sort of conservative approach on this one with the 5% decline. I think either way, maybe the most important column here is that final one where we're comparing it to 2019. As I said earlier, 2021 is a tough year to compare to. And there was always going to be some hiccup in terms of the post-COVID makeup of the industry. But I think we can take a lot of encouragement from the fact that we are above 2019 levels, pre-COVID levels, and so I think that leaves us with a strong basis from which to stimulate growth moving forward. As I mentioned, that first half saw some positive numbers. The Richmond's jewelry masons, that includes Cartier and Van Cleef, had sales up 24%, and that would include watch sales within their jewelry masons. Richmond has separate specialist watchmakers, but Cartier also sells watches, so does Van Cleef. But overall, their jewelry sales came up or their sales in general came up by 24% in the first half of 2022. Similarly, at LVMH, the jewelry and watch division had sales up 28% compared to the previous year. Signet, which is more commercial sort of a lower price point than the LVMHs and Richmonds, but certainly has a wider reach within the United States. Had sales up 3%. Then also in China, Chow Tai Fook, China Hong Kong, in the first quarter, their sales were up 8.5%, and they saw a decline of 3.7% in the second quarter. And in India, Titan Company, which is the biggest branded jeweler in India, saw a slow start to last year, but sales basically tripled, I think, from in that second quarter. Not I think, they did. Okay. So so that was the first half, and so that momentum, I think, carried the industry through the rest of the year. When we look at the holiday season, it tells a bit of a different story, and we do see that slowdown in sales through that, and the effect that those that the economic uncertainty, the COVID lockdowns in China, and the geopolitical influence had on the market. MasterCard reported jewelry sales of were down 5.4% in November, December. Basically, that constitutes the holiday period. In the fourth quarter, the Edge, which works a lot with independents, reported a 9% decline in jewelry sales among independents in the fourth quarter, year on year. LVMH and Richmond continue to show strong growth, but it's lower than the first half of the year. If we could only all have such lower growth, but still, it's worth noting the trend. Signet hasn't reported its holiday sales this year, but based on their guidance for the fourth quarter, which ends end of January, we estimate that their sales, or they anticipated sales to drop by 5% compared to the previous year. Birks reported holiday sales 3% below previous year, etc., etc. I'll let you read the rest. It's worth noting the China Hong Kong jewelers, Chow Tai Fook and Luke Fook, saw double-digit declines in that fourth quarter, and that was a period of intense lockdown and restrictions on travel. And so that puts into perspective the year. It began with momentum and it slowed down towards the end, and this is where we enter 2023 with on the back of that sort of mixed holiday experience, and I don't think overly disappointing. I think there was some expectation for these sort of numbers, and but it's again to reiterate the point that the beginning of this year has a different tone about it to the beginning of last year. And so where are we today? And when we look at the market, particularly in the, and I wear two hats as I present this. The first is as a journalist who's covering the diamond trade. What are the big stories that I'm looking out for in 2023? And then as a self-proclaimed analyst of the diamond market, what are the trends that we're looking out for that will affect that supply-demand dynamic and pricing dynamic? And so I've divided it into six. The first is that continued uncertainty about the US economy and economic growth. The second is the China recovery, and that's a change in storyline, because whereas before we were talking about, last year we were talking about the ongoing lockdowns. Today, China, it's more about the recovery in China and the effect that could have on the wider market. There is always the lab-grown diamond story. I gave this webinar yesterday as well to the sort of the US time zone, and most of the questions were on lab-grown. So I challenge you all to think a bit out of the box if you have any questions, that are not lab grown related, it will be nice. But feel free to ask what you wish. And you can do so in the Q&A. The fourth story is that story of Alrosa Supply. The fifth being the De Beers Botswana negotiations that are ongoing. And this is really from mainly from an editor's hat, that I'm intrigued by this story and where it's going to lead. But also it has some implications for the wider market. Then finally, there's this trend of source verification that is gaining in importance and has steadily gained in importance for the last 5 years. But with the geopolitical issues that the industry is facing, with the Russian supply, it's certainly gained a greater importance. And I divide these 6 stories into 2 categories, or 3 categories, let's say. The first 3, I think, all have to do with demand and how how the US economic sentiment, Chinese economic sentiment, and the impact of lab grown is all having an effect on the consumer, how the consumer is relating to natural diamonds. And on the demand side, Alrosa and De Beers are supply stories more. And then the source verification is a combination of both. There's an increase in demand for responsibly sourced product, and how the industry is supplying that is a major issue and challenge for the industry. So let's just deal with each one separately quite quickly. I don't want to go too much over time, but let's go through each separately and give a bit more context for each. When we look at the US economy and how it's recovered so strongly from COVID, and then there's been this dip in consumer sentiment in the last half year. It kind of makes sense when we look at it from a household savings point of view. And so this graph is government data measuring savings as a percentage of disposable income. And we see that it's been fairly stable and steady over the years since the beginning of the millennium, and over the last 2 decades. And when COVID hit, we saw this spike in savings. People were saving more of their income. And that was because they were stuck at home. They weren't spending on travel. They weren't spending on the experience economy that had become so dominant in our lives. And they were also getting stimulus checks from the US government, and that all fed into the spike in savings that the average household in the United States at the peak was saving over 30% of its income, which is quite a statistic. And that obviously came down, but it had these spikes during when the government put through those stimulus payments, and since then there's been initially quite a sharp decline, but a gradual decline to the point where in the second half of last year it reached an historic low in terms of how much income was being retained for discretionary spending, essentially. From our point of view, we do see a bit of an uptick in January over here, which may be fed into those strong jewelry sales that were reported, or a slight uptick in jewelry sales, but we do see a slight increase in January, but it's still from a historical level quite low. And particularly when we look at last year and put it in this perspective, it kind of makes sense. And And so when we look at the economy and the jewelry market and diamond jewelry market at the moment, we sort of see this sort of flow of events that was post-COVID. There was always going to be this concern about inflation as people came out and spent. They had that all those the savings that they had to spend, and that fed into rising prices, and that led to higher interest rates, and that led to a higher cost of living and less savings that we saw in the previous graph and lower sales. And less savings leads to lower sales of discretionary or luxury items, and lower sales. Excuse me. Lower sales amongst retailers leads to them being more cautious in terms of their inventory buying. And so post-holiday season where we are at the moment, we see lower activity than normal, which in this context makes sense, I think, in my mind at least, that the first quarter is usually, as I said, a period of stronger activity in the diamond market. We're not seeing that at the moment, and I think De Beers sort of hinted to that in a very interesting quote from my point of view, when they announced their January sales results after the January site, that Bruce Cleaver, who next week is actually stepping down as CEO of De Beers and continuing as chairman. It's an interesting time at De Beers. There's a lot of leadership change. But also Bruce will be continuing as chairman, which is a good thing, I think. But Bruce said that site holders took a cautious approach in late 2022 in planning their 2023 allocation schedule, with a greater weighting of goods to be purchased as the year progresses. And so what that means is that site holders toward the end of last year, the way the site works is that site holders present to De Beers their application for goods over the next year, and in terms of how much they want and when they want those goods to be delivered, and so there's a schedule of delivery for of De Beers goods. It's one of the big sort of advantages of being a site holder. You need the consistency of supply in order to provide the polished diamonds that you needed to supply your retail customers. And so under normal in previous years, where first quarter has been has brought strong activity, and we see a relatively large site in January, February, De Beers is saying here that site holders have delayed those larger purchases to later in the year, and that's again sort of gives us some indication that there is a bit more caution in the market at the beginning of this year compared to certainly last year, when the January site was really large, and we saw that increase in pricing as well from De Beers in that January site. And so the US, this economic caution is feeding into caution about the economic caution as reflected in those holiday sales is feeding into the market. Yesterday, I think it was yesterday, the government announced its GDP numbers for the fourth quarter, and they were better than expected. It was 2.9% that the economy grew, and I think that did calm some of those recession fears. And so I think the market is kind of waiting to see how things settle and improve maybe as the summer season comes along. In China, as I mentioned, China's been a big influencer in terms of sentiment. in 2022, and that's changed this in the last month or two as the government there lifted its COVID restrictions in time for the Chinese New Year, and also opened its borders, particularly with Hong Kong. And so we are hearing that there is a gradual return to business, a gradual increase in presence of Chinese buyers in Hong Kong, and long may that continue. But the fourth quarter was slow, and the opening of the economy was maybe a little too late to really stimulate Chinese New Year sales. And so I don't expect that when we get data from the likes of Chow Tai-fook and Luke Fook, that they would have had a booming Chinese New Year season. But we are seeing and hearing a greater optimism from the retail sector that is active in China, that things are starting to improve. And so we do expect that there is this pent-up demand that is waiting to be released in China in a similar way that we saw in the US in 2021 when there was that sort of boom in sales. And when we do start to see sales numbers, we would expect them to show some growth, given that last year's numbers were quite weak in China, for the retailers and for the rest of the trade in Hong Kong, China. And so the comparisons are favorable, let's say, for 2023 in China. Okay, so when we think about the third story that was on our list, there's no doubt that lab-grown diamonds continue to see a strong demand. There's rising demand, but I think it's still from a relatively low base, and so we would expect that there is this growth that this young market is experiencing. And there's no doubt that there's also some cannibalization of the natural diamond market. When a consumer comes into a store, it's offered as an alternative to the natural product. So there is this competitive sort of competitive landscape that the two are playing in. But there have been some surprising developments, I think, in how, or surprises in how the lab-grown market has developed. For one, it's really growing in the larger stones, also in the engagement ring segment as well, I think. But the initial expectations were that it would gain market share in the smaller diamonds, and that hasn't taken effect. And in fact, in the last number of months, as we've seen in the 30 pointers, there's been this increase, but also particularly in the melee goods. Melee has been fairly stable in the last 6 months or so, as the rest of the market has come down, and that would be. And that's been somewhat surprising in the lab-grown context, that we would have thought that if there's fewer Russian goods coming to the market, maybe there would be shortages in the small goods, where Alrosa accounts for a larger portion of the market, and that there would be this sort of shift to fill that supply shortage in the lab-grown space, but it hasn't occurred. In fact, lab-grown small sizes are the smaller melee goods are quite weak, and the focus is quite, or haven't been as strong, at least, and the focus is quite clearly on the larger stones, which is where the bigger profit is. And so when manufacturers decide how to grow or what to grow or manufacture in the lab-grown space, they can make that choice, and they're clearly going to make the choice to grow a larger stone than the smaller goods, I think. India is really focused and sort of earmarked the lab-grown space as a growth area. The finance minister in her budget speech when was it, a few weeks ago, made that point quite clear. In fact, it was pretty much the only mention of diamonds in the budget speech was on lab grown, and they really are. It seems that them and it's also within the industry been talking about this opportunity to invest in lab grown as a growth area for the trade and for the country. And we've seen that the lab grown segment in India has increased over the last 4 years. I think if I remember correctly, when they started publishing data 3 years ago, 2019, I think, their lab grown, the polished exports of lab grown were around 300, 400 or 500 million. Today it's 1.7 billion was exported in 2022, and that was a 50% rise from 2021. So there's clearly an intention to grow the sector there, and maybe that's a good indicator of how the lab grown market is growing in general. At retail, there seems to be a mixed dynamic in how retail is approaching lab grown. Our reporter Leah Mirovich, we ran a story not too long ago, interviewing a number of retailers who were selling lab grown, but were sort of doing so on the quiet because they didn't want to necessarily be associated with the product or have the product define them, as it has come to do among many. There's still this sort of unease about promoting lab grown among some jewelry retailers. And on the other hand, there are those who are quite open about it and marketing it and selling it to customers that come into the store according to budget. And so, for example, if a couple comes into the store and they have a certain budget, there is a wider option for retailers to show them. The question becomes, as we've pointed out, and Martin has pointed out in his New Year message, is what are the disclosures that the retailer is making to those customers who are walking into the store in terms of the value proposition that lab grown presents compared to natural. Because we are seeing a decline in prices, we have seen a sharp decline in prices of lab grown in the last year, and that's facilitating a differentiation or segmentation of the two products into different marketplaces, and I think that is something we're going to see more of in this as we move forward this year. Prices are falling, and there's been an interesting development, I think, within the lab-grown space. There's this drive to get the pricing off the RAP list to present to have a standard. Whether it's to have a standardized price, I don't think so. They would still look at different categories, at different price points, at different categories. But it's interesting that there is this sort of drive, and Rapaport doesn't have any skin in the game. We'll leave it to the lab-grown industry, but there is this drive to get off the discount system that the natural diamond industry operates, and that's because we're seeing these crazy discounts of lab-grown, of 98% below, 99% below the list, and so that's possibly unsustainable. I think it's just interesting from an editorial point of view that there are these different philosophies that have developed in the lab-grown space. You know, whether you should how you grade a lab-grown diamond, if you should grade a lab-grown diamond, the pricing mechanism. De Beers bringing in that standard sort of $800 per carat, based on cost plus philosophy that many that not too many have followed. And so sort of watch the space, and there's always it's still finding its feet, it seems, the industry. And that's why I say again, it's still a small portion of jewelry sales, but it's growing. Okay, so I think from an editorial point of view and from my own personal point of view, I'm very interested in this in the story that continues to develop. De Beers and Botswana are negotiating their long-term sales and mining agreements. There are two aspects to this this negotiation that's going on. Every 10 years, they renew a sales and marketing agreement, which basically dictates the how De Beers will tackle beneficiation, will tackle its where, how it will sell its goods, how much of production will Botswana receive to sell independently, all these sort of factors. And then this time, and that sales agreement was up for renewal in 2020, was delayed because of COVID, and then it's been delayed once or twice more, as there are clearly sort of deeper issues on the table. And just this last week, President Masisi made a speech in his hometown, I think, where he referred to these negotiations and saying that the government wants more, a bigger piece of the De Beers pie in terms of production and in terms of the higher value goods, I think, as well. I would imagine that he was referring to, and so and that was reported in the local press. I think Bloomberg ran a story as well on that, and I can imagine that that for me just indicates that there is this sort of prolonged negotiation going on, and there's a lot on the table that De Beers might, it's pushing De Beers to possibly give up more of its production to the Botswana government. And it will be interesting to see how far the government can push De Beers in that sense. So it's a really, and that is, the next deadline is June. So I doubt that that De Beers will want to delay it too much further, at least because it does feed into some uncertainty amongst its clients. And the second aspect of the negotiations are the mining rights that De Beers has in Botswana, and that is, my understanding is that that's a much longer term deal and is up for renewal at the same time. And who knows how the two aspects of the sales and the mining are playing off each other. I would imagine that there's maybe some leverage that the Botswana government can use in its mining licenses that it gives De Beers to get more out of the sales. But I'm not privy to the discussions. I just kind of watch with interest and reporting with interest. It's worth noting that the partnership is really a special one. That De Beers, Botswana has a 15% stake in De Beers. Anglo American holds the rest, and there are also these these joint ventures within the De Beers structure. Botswana being the mining company that operates in Botswana. And there's a 50-50 a partnership in running that, and same in DTC Botswana, which is kind of the unit that aggregate or mix or categorizes and supplies the beers to sell to its site holders, and also supplies to the Botswana government the portion of production that's available to them. As I mentioned, beneficiation is a big would be a big topic in this in these discussions, as the government wants to diversify its diamond activity to more and continually to more manufacturing in Botswana, to rough trading, and to bring in other services related to the industry there as well. Okay. I'll go through the next few slides quite quickly, although this ALROSA story is obviously a very important one. But the industry is still sort of finding its feet on how to deal with the ALROSA supply, and that's both in the midstream and also at the retail level. And the US has imposed the broadest possible sanctions on ALROSA that occurred in April last year. And there was this sort of loophole that many reported on, including ourselves, of substantial transformation. What happens if a Russian origin diamond is not directly imported into the United States, but it's sent to India and transformed into a polished diamond, which is the argument goes that it's a different product, and that becomes an India sourced diamond and then sent to the United States. Can a retailer sell that diamond as an India, having gone that substantial transformation? The initial the understanding was that it could, but there are questions around that, and my understanding is that as a renewal of sanctions are being considered, and also pressure put on other centers to apply sanctions, particularly Europe, to join the United States in its sanctions against ALROSA. This is a question that's coming up within the sanctions wording, and it's particularly relevant for the trade. Is it legal to buy these diamonds in the or bring these diamonds and trade them in the United States? And is it ethical for the industry to do so? It seems that that ALROSA has been selling into the market. How, and the question has always been how and where are those goods going? ALROSA, similar to De Beers, has a list of they don't call them site holders, but it's a similar concept. They're ALROSA Alliance members who buy on a continued basis. And my understanding is that the company renewed made a new list of those long-term clients and has been selling to them on a continual basis. And one of our difficulties, or my difficulties, is getting data on ALROSA at the moment, because not only from an ALROSA point of view, that they're obviously not publishing the wealth of information that they used to, but also it's very difficult to get data from the big buyers of diamonds. In fact, over the last year, for whatever reason, the likes of the Antwerp World Diamond Council is no longer supplying its monthly data as it used to. It's not. It hasn't published in a year, in fact, and that's when we talk about transparency in the industry, we want to see more data. We want to see what's happening, at least in the trading centers, and certainly the same applies to Dubai. That Dubai put out a press release today saying how their industry has grown, but they're not giving micro data that gives us more insight into how, what are the polished imports to Dubai, what are the rough imports to Dubai, where they're coming from, etc. And this should all be public information, but it's not. The various government entities in Belgium and India have do supply separate data that's sometimes a bit more difficult to find. But we managed to dig up some from the Bank of Belgium and also from the India's Commerce Ministry, have break down the rough imports by country. And we see that the decline wasn't that dramatic in terms of those two countries' imports of rough from Russia. When we combine the two, we see that by value, in fact, in the 10 months of January through October of 2022, the imports from Russia increased by 3% as a combination of the two. They increased more in India, and they came down a little bit in Belgium. But by volume, they came down as a combination by 8%. And so at the very least, we are seeing that there is movement and there is a flow of goods into these centers. The other, traditionally, Belgium has been the biggest client of Alrosa in terms of bringing imports from that company. The other big ones would be, not on this list, would be Dubai and China, I think, as well. And of course, there are local manufacturers in Russia as well that Alrosa would sell to. So there is a path to market for Alrosa goods. It's and doesn't necessarily need to be to the United States. These goods are legal to buy in China and in India, among the jewelers in India as well. And so there is this path to market that the goods are still coming through. And it's important for me. It makes my job easier when I know how much is coming to the market, and we don't have that from Alrosa at the moment, understandably. And what does it mean for the trade? It leaves a question and a challenge for the industry if those goods are not legal to trade. And our view is that also, even in polished form, they're not legal to trade in the United States, or for retailers to buy them. And then there's this ethical question of whether many jewelers and brands are, whether it's legal or not, are choosing not to trade in those Russian goods. And so we're seeing sort of a bifurcation of the market, of those who are willing and for those for whom it's legal to trade in those goods, and those who are not, and able to prove that they are not sanctioned diamonds. And it doesn't necessarily only apply to Russia. The Zimbabwe goods are also still sanctioned in the United States. And so that leads us to this final point of source verification, and being able to prove where your diamond comes from and trace it through its journey to the consumer. And this is really it's always been driven by the brands who want to tell a story of their brand, and this underscores the message that they want to give, that they're sourcing responsibly, that they're contributing to their communities across the pipeline, that their product has had a positive net effect on the planet, on communities around the world. And that only underscores their brand and enhances their message. And it not only applies to the social aspect of applying to geopolitics, that's a result of the geopolitics, etc. But there's of course also the environmental and sustainability question, and we've seen an increase in those blockchain programs, those traceability programs that are being offered to the industry, and that's over the last number of years. But the geopolitical climate has changed in the last year, and that has given a bit of a boost for the industry in terms of demand for these programs and that ability to show that your diamond is responsibly sourced. It's something that will be amplified as we move through 2023, and I expect it to be one of those stories and developments that will really shape the market, not only this year, but how we will be operating in years to come. So that's my presentation to you today. I thank you for listening. I'm sorry if I went over time a little bit. I went quite a bit over time. I need to shorten these presentations, I think, but I appreciate you sticking it through, and I'll be happy to take any questions that you have in the Q&A. Otherwise, please feel free to reach out to me by email, on Twitter, and well, I'm less active on Twitter, to be honest, but maybe LinkedIn is a better format, forum. I should put my LinkedIn profile here, but it's basically Avi Krawitz. Okay, so let's take a few questions. If there are any. I have one here. It says, just a few hours ago, the Economic Times in India, I assume that's in India, stated that the fresh tension between the US and China is affecting the sentiment of Indian diamond exporters who have reduced capacity utilization of their cutting and polishing units by 40%. Is this true? How do you expect the impact will be? Well, I'm not sure if the tension between the US and China would affect Indian manufacturers. They sell to both, and both separately. I don't think there would be sanctions. It would lead to sanctions between the two. I think it would play out as it did before in terms of the import duties, the trade terms that those two countries have. I would need to think about how it would affect the Indian diamond exporters in terms of they're reducing their capacity at their factories. I'm not sure what the number is. I don't want to confirm. I can't confirm whether it's 40% or 50% or what the number is. We know that it's lower than capacity, and it's lower than it was. The question on that will be going back to looking at those inventory levels and how that plays out. If there will be if the idea is to lower production so that supply can meet lower demand, I guess. But I think at some point we're also seeing demand increase in China. So all of the above slides played over again, that if if there is this sort of uptick in demand, then that will push manufacturing levels up again and sort of have that ripple effect on the rest of the trade. And let's hope that does happen, not only from China, but I think but also of course the US has the greater influence on the market. Okay, I'm just going to take this final question because there aren't any others, or there is one more. Let's see. Okay, I'll take these final two questions. With Rap's dislike of LGDs, the lab-grown diamonds, and this audience members as well, he says he doesn't like lab-grown. Why don't they start monitoring and publishing on the declining annual values of them? Well, I think that's why there's this drive to get off the discount system, because those discounts are staring the trade and the consumer in the face. That the decline in value, that if you see 98, 99% below RAP, it shows the decline in value. Why the lab-grown industry doesn't publish that, because they don't have an interest to. It's in their interest not to publish values, and no business likes to show their margins or their they see value in their product, and so they would want to sort of accentuate the value of their product. The rise in prices of 30 pointers over the last month or so, more supply driven or demand driven? Yeah, that's the question that I was trying to sort of put out there in my slide earlier, that we are seeing a decline in supply. We have seen a decline in supply. I think that is related to that drop in Indian manufacturing. But I think there's also, as I mentioned earlier, the sort of play on how to sell those goods as part of a parcel of uncertified goods, or as certified. And then I think there has been I'm not sure about the demand on the demand side from higher up the value chain. I think it'll be interesting to see how China influences the demand for 30 pointers, because generally it is a strong item in China. Chinese demand has a stronger influence on the 30 pointers than it does on on a global scale, than it does on other categories of certified goods. So I think the rise in prices maybe has been more of a supply play in the last few months, but I think moving forward, maybe it will be I think as we see China come back into play, it'll give greater support to those prices. But we'll have to wait and see. Okay, so thank you very much, everyone, for sticking it out and attending the webinar. I hope I gave you some insights and something to think about. As I said, if you have any other questions or just want to say how much you love me, you can send me an email or reach out on LinkedIn. I'd love to hear from you all. So thank you all. Have a wonderful rest of this quarter, and best of luck and great success to everyone for the rest of this year till we meet again. I wish you luck and health and blessing. And so I'll sign off with that. Thanks everyone for joining. We'll see you soon.